So we have covered the previous topic where we did the basics about discussion of what derivatives market and what are different types of instruments. So we did discuss that different types of derivatives market and contracts like forwards and contingent, correct? And within those forwards, you had futures, forwards, and options, future forwards and swaps. And the contingent claim was options. Am I correct? We discussed about what is an exchange traded and what is what is an OTC market overall. And then in this topic, we just touched upon different types of markets, forward, futures, options, and all. But basically, you know what, I kept options separate. So we focused only on forwards, futures, and swaps. Option, the reason I have kept it separate because option has a complete different fundamental of valuation and complete different structure, correct? Also on this topic, we did discuss about arbitrage. Am I clear? Everyone recollect that? Now, based on this principles of arbitrage and different types of derivatives market, we need to understand one very important element, that these instruments of derivative, why are they called derivative? Because their prices are derived from something else. Do you recollect my example of a wooden chair?
Yes.
Right? So what are their prices dependent on? Well, the derivative instruments prices are dependent on underlying asset, correct? Now, how are they connected? How exactly we derive price? And what is value? What is the difference between price and value? Ideally, we consider price and value as the same thing. But how come in derivatives, they both are separate, and what is the reference or meaning of that? That's what we are going to see in this topic. But again, I'll repeat in this topic where our focus will be only on forwards, futures, and swaps. So in the previous topic, we have covered what is forward, futures, and swaps. And in this topic, we are going to cover the pricing and valuation of forward, futures, and swaps. Well, the separate topic which I have created, which is a combination of both the readings, in that we understand the basics of options and the pricing valuation of options. So although in your institute curriculum, you'll find everything mixed up in this two topic itself. But as I said, I have pulled out options from this and I've kept a separate reading for options, correct? So in this topic, we are going to find out the pricing and valuation of which type of derivative instruments, my friends? Only three.
Future, forward, and swap.
Correct. Future, forwards, and swaps. These are the derivative instruments that we are going to focus into. For option, it's a completely different thing. So we're going to do it separately. Now, just for your reference, what is the index here? First, I'm going to focus on what is the pricing methodology, what is the basis of pricing, and then what is valuation and what is the difference between pricing and valuation, and what are these concepts based on. Okay, so let's go to the basics of the pricing and then later on valuation. So the first thing you see is that the probability distribution. If you recollect what is probability distribution gave us the different scenarios of what can be the value of asset or the returns from an asset and the respective probabilities, the expected probabilities for it, right? Here, what we are going to see is that how much is the investor willing to pay for the derivative instrument? How much is the investor willing to pay for the derivative instrument? Why? Because see, derivatives are prices of assets, not today, but after some point of time in the future, right? So what and how much are investors willing to pay for a stock 1 month later, 2 months later, 3 months later? That's what derivative is. So here it is all about, here it's all about the expectations. What are the expectations? What are investors' expectations? And they are based on their future expectations, their future, how much returns they will get. And all that is based on their probability distributions. So using that probability distribution, the investor forecasts the future over a holding period spanning from 0 to T. What is 0 to T? 0 means today, and T is time to maturity. That is the futures contract or forward or swaps. They all the derivative contracts, they have limited time period. That limited time period is what we say maturity. So it can be 1 month, 2 month, 3 month, or anything. Okay. The mean of distributed is the expected price of the asset at time t, denoted as E of ST. E means expected, ST is spot at time t. Do you recollect? Spot at time t means what will be the value of the asset. Let's say the time is 3 months. So what will be the value of asset after 3 months? That expected value of the asset after 3 months is called E of ST. And how do we get E of ST, guys? Well, the E of ST can be denoted, let's say there are different situations out here that the economy will be boom, recession, or stable. And based on that, what will be the probability? 20%, 40%, and 40%. And in that case, what will be the price? So whatever is the price, and that expected price, the weighted average price, is what is this. Clear? Now that expected price will be different for all different investors, isn't it? Because every investor perceives the market in their own manner. Am I correct? Right, everyone? So
Yes.
expected ST means spot price on maturity, which is expected by me, which is nothing but the future price, right? The future price expected by us, correct? So E of ST is called expected price of spot at time t. Everyone with me? Expected price of spot at time t, where t is maturity. Clear, everyone? Now for us, this is nothing but the future price, the expected future price, or we call as the theoretical future price. Is that clear, everyone? Now, you all have done equity valuation, and in that, how do you find what is the value of the price of the share after, let's say, 3 years, P3 or P4? How do you find that? Any idea? If I were to find, let's say, P3, how do I find, P3?
You take the from P4, yeah, from D4
Over
the
R,
dividend.
the discounting rate, right? And if I want to bring this to P0, I have to discount this P3 by the cost of capital, which is R,
Yes.
3 times. And then that's where I get P0, if I have to come from P3 to P0.
PT through P0.
Now, one thing that you see here common is that discounting rate, and that discounting rate is when you value equities nothing is but underlying asset, right? Correct, everyone? So imagine an equity, which is an underlying asset. How do you discount that? You discount that using what is the discounting rate there?
K.
Yeah. KE, cost of equity.
KE.
How do you derive cost of equity? Any idea?
Sorry?
How do you derive cost of equity? I'm just digging deep. How do you derive cost of equity? Very simple question.
Cost by the weighted average.
Cost of equity. I'm not talking cost of capital. This is where your revision doing is essential. CM, capital
CAPM.
RF plus RM minus RF into beta, isn't it? What is cost of equity or required rate of return on equity? It is nothing but RF plus risk premium, that is RM minus RF into the beta, isn't it? That is going to be your discounting rate. If you, I don't know why it's not on your tongue immediately, it should be there in your blood now. We've done that in corporate finance. Discounting rate, we did weighted average, that is cost of capital. One of that was cost of equity. And then the entire equity valuation is based on KE. So whenever I say KE, it is nothing but CAPM, capital asset pricing model by default, right? Now in that capital asset pricing model, what are the constituents in it? Is it only risk-free rate or also includes a risk premium?
Risk premium too.
Correct. Now, tell me one thing. We've done different types of investor classes, different types of classification of investors. Do you recollect them? We've done that. Different categories of investors. Yes. Input also.
Yes.
Yes.
Risk averse, risk neutral, and risk taker.
Very good. This is the one, right? Risk seeker, risk neutral, and risk averse. We've discussed all this thing in portfolio, but just to understand here, what is a risk seeker? What does he like more? If given multiple choices, the risk seeker will always go for the choice where the risk is
High.
not caring for the returns, right? So risk seeker wants that excess of returns all the time, right? And the focus is just risk, irrespective of the returns. How about for risk averse? Risk averse will only take a risk if offered
Higher return.
slightly extra returns.
Extra returns.
Nothing but risk premium. Now, listen to me carefully and do respond, everyone in the batch. I see only Deepthi responding. I don't know why deviation things are not responding. Anyways, now listen to me carefully. This is the difference of doing CFA and other curriculum, okay? Now, when you discount equities, you discount them using cost of capital or cost of equities, right? Now, before that, tell me one thing. What is a default assumption when it comes to equities and when it comes to financial markets? That investors are
Risk averse.
very good. Risk averse means, do they only want risk-free return or they also want something extra for the risk?
They want something extra for the risk.
Correct. And that is what we call as risk premium. And therefore, whenever we invest in risky assets like equities, we do expect investors to be risk averse, and therefore their returns constitute two parts. Not only, it doesn't only constitute risk free, but it also constitutes what? It also constitutes an element of risk premium, which is RM minus RF into beta in this case. Okay, everyone. So when you're valuing underlying asset like equity, your discounting will be only risk free or risk free plus risk premium. It is going to be risk free plus risk premium because you assume the investors in that case are risk averse. Am I correct?
Hours. Yes.
Now that's for the underlying asset, but for derivative things are very much different. We are going to see that. Okay, so right now let's focus on to the underlying asset. The required rate of return on the underlying asset. To determine the value of asset, that is P3, P4 and all, the forecasted mean of the probability distribution is discounted to the present value. We bring everything to the present value, and the discounting rate is called required rate of return, which is nothing but our opportunity cost of risk-free, but it is at least risk-free plus something extra, which is what we call as risk premium. Am I correct? So the discounting rate is not only risk-free, that's at least risk-free. And if it is a risky asset, there will be something called as risk premium also. Now, three categories of investor. Risk neutral will engage in risky investments if only offered return for risk neutral guy. What is the thing? Does the risk neutral guy care for the risk?
No.
For him or her, irrespective of the risk, the return is the focus, right?
Yes.
Correct. So see this. Risk neutral willing to engage in risky investments for what they expect to earn only risk-free rate. So this is very important. Until now, we had discussed what a risk neutral guy is. That for them, risk is not an important thing. Return is the only focus. Why? Because they feel that there is probably no risk and therefore the only return is going to be risk-free return. So they do not even think about risk because for them, the perception is that all the assets have same risks. For them, all the assets have same risk. So for them, the return is the only focus, and therefore they are happy with the risk-free rate also because they don't get worried with the more riskier part like risk averse. Risk averse, for them, risk is undesirable and are unwilling to accept risk-free rate. They need something extra. And that compensation that they need, that's why their expected returns are higher, and that the compensation is risk premium. So if offered risk premium, only then risk averse guys will invest, but risk neutral doesn't care. On the extreme contrary, the risk seeker is the one who has negative risk premium. They are willing to pay more to invest They are willing to take more risk. They prefer risk over the certain part, right? And that's why we say it is quite unrealistic. It's not practical, but it's not completely impossible. You'll find some people who are completely exceptional or irrational. So this is a very rare scenario. Which is a rare scenario out here? Risk
Seeker.
there is
The negative risk premium.
just a theoretical scenario. Practically, we don't have such scenario. Very rarely we do have such people. Most of us are either risk averse or in few cases are risk neutral. Now, I have a question to everyone. What happens in hedging? What happens in hedged position or hedging? Tell me. What happens in hedging or a hedged position? What do you mean by hedged position? Hedged position,
The hedge position to reduce the risk of the earlier
taken
position.
Correct. So if you have taken a stock and now you're worried that the markets will go down, so you may probably sell a future or a forward. Okay. So if the stocks go down, you will make a loss in the underlying asset, but your future will make money. Clear? So overall, your net outcome will be your gain
Zero.
in one position will be covered by the loss in another position. Are you getting
Zero. Yes.
You are protected, hedged. Your gain in that case is restricted, but even your loss is restricted. Am I clear? So a hedged position does not fetch you more than risk-free rate. Remember this. A hedged position does not fetch you more than
Risk-free rate.
Risk-free rate. Now, the entire reason of derivative creation was for hedging. So here our assumption about derivatives is what I'm slowly and gradually coming to that point. Okay, hold on till that point. As of now, we are just discussing everything about the risky asset, that when you invest in a risky asset, you expect investors to be risk averse, and therefore they need not only risk-free rate, but risk premium. Clear? So now when I'm going to estimate the price of the asset, what is going to happen? See this. So the current price of an asset is obtained by discounting the expected future value, and the assumption while pricing is that investors are risk averse and therefore they also require a risk premium, which is denoted by the Greek letter called lambda. That's okay. So when you're going to find the present value of the expected price of the stock, you're going to discount them with not only risk-free rate but also add a risk premium to it. Am I clear, everyone? Right? Therefore, see this. Hence, the discounting rate used for expected future value of the asset with no interim cash flows is a sum of risk-free rate and risk premium. Therefore, when I'm trying to find the present value of the stock, I'm going to take the expected value of the stock in the future, which is nothing but expected spot price. Is that clear, everyone? And I'm not going to discount that with only risk-free, but I'm also going to add one more thing, that is risk premium. Do you notice this? This is because it is an underlying asset and here investors are assumed to be risk averse. That's the reason behind adding a risk premium in the CAPM equation, in the CAPM equation. Is that clear, everyone? Correct, everyone?
Yes.
Now we are talking all about not derivatives, but all about the underlying asset. So till now, what is the conclusion? When you invest in the underlying asset, and when you are estimating the future price of the underlying asset and what should be the price after 3 years and what should be therefore the price today, in that case, you discount them with the risk-free plus risk premium. And the reason you discount them with risk premium is because investors are risk averse and they need extra returns for investing in risky assets. Is that clear? Correct?
Yes.
But apart from holding the underlying asset and just getting price, is price the only thing that you get when you hold the underlying asset for, let's say, 3 or 4 years? No, you get some other things also. And that other thing is the benefit, dividends. Okay. So now we are going to discuss about the benefit and the cost also. Now you will be wondering, is there a cost of holding the asset? Yes, we'll come to that. So first of all, what are the benefits of holding an asset? First of all, if you're holding an equity, you may get dividends in the future. So if you're holding the asset for, let's say, 1 year, so within 1 year, you are expected some dividends. If you're holding a bond, you may expect some coupons. If you're holding a real estate portfolio, you may expect some rent. So dividends on stocks and coupon payments on bonds represent the benefit of holding the securities. However, if you're holding a commodity, like let's say you're holding tons of steel, where are you going to keep them if you're holding them physically? You will keep them somewhere in your backyard or in some warehouses. You will have to keep them in some of the warehouses, right? You will have to physically store the commodity. So when it comes to commodity, there is a storage cost involved. If it's an equity, there's no storage cost. The cost of storing equity is very minuscule. It is only limited to the demat charges by bank, dematerialization charges, which the banks charge you and which are very nominal. Are you getting my point? But storing commodities is riskier and it's costly. Am I clear? So overall, if we look at the risky assets, there are some benefits also, and there are some costs also. Can you tell me what are the benefits that we have here? Yes, we can have benefits like dividends or coupons. But then there are costs also, which can be like the storage cost, right? So benefits and cost. So holding the commodity does have some cost. I've discussed about the benefits and I've discussed about the costs. Now let me discuss some more thing that is called the convenience yield. What is the convenience yield? We're going to discuss that in detail in the non-monetary benefit, but just for your reference. For example, let's say you are a petroleum refinery company. A petroleum refinery company does what? It takes crude oil from those who sell crude oil, right? And then with that crude oil is the raw material for the petroleum refinery companies. With that crude oil, they will refine it and create various petroleum products like petrol, diesel, thermocol, paints, chemicals, etc., etc. Correct? Now, tell me, if the prices of crude are increasing, and if you already have a physical quantity in hand, not in futures, but as an underlying asset, there is some non-monetary benefit in the way that you may not have to now buy these crude at higher prices from the market. So because you are physically holding it as of now, you are saved from that volatility in prices. And in the future, you can sell it at a higher prices. So right now, you may have not sold it, or you may not need to buy it. But in the future, when you sell it and the prices are increasing, there is a potential benefit. Now that potential benefit of holding the asset in the spot or underlying asset rather than a future is called a non-monetary benefit. Are you getting my point? We'll discuss about that in length also. But convenience yield is a return for the convenient of having the physical asset rather than not having it. You can use it for your production or you can sell it later at a higher price. That's the convenience yield of holding an underlying asset. Are you getting my point? Right? This convenience asset is only and only possible in the cases of commodities, because commodities, having commodity or inventory at hand when there is shortage of that in the market. Now let's assume that there is shortage of crude, right? And then in that case, you holding a futures contract on crude and I holding a physical spot contract on crude, I right now having the crude in my storage is better than you having a futures contract, because your contract is uncertain. I am sure that I have the physical quantity of crude right now. Are you getting me? So in case of shortages, this having the physically having the commodity is more valuable than not having it. Are you getting my point? That's why we say there is a convenience. It's an advantage. It's a convenience yield that you have when you're holding a commodity in the spot. Are you getting my point?
Yes.
So all in all, there are some advantages of holding the asset in the spot, and then there are some disadvantages in the form of storage cost. Clear? The net of this cost and benefit, is called cost of carry. Cost of carry is the cost of holding the asset. Well, the cost of holding the asset, there are two things now. What are the two things? You have a cost and you have a benefit. You have a cost and you have a benefit. Tell me, if you're physically holding an asset, you have the benefit and you have the cost. But if you're holding the asset in futures, will you get this benefit? Will you get this benefit?
No.
You will not get this benefit. So therefore, this price is adjusted from the futures. Otherwise, there will be difference between futures and spot. So this benefit and cost is adjusted from the futures price that we are trying to predict. What are we trying to predict? We are trying to predict what will be the expected price of the asset in the future. We are trying to predict the derivative prices. And when it comes to derivative prices, I am predicting, let's say I'm predicting the futures price of an asset. Futures and forward pricing is the same. It's only that one is traded on exchange, another is traded on OTC. So the fundamental of future and forward prices of the stock or a commodity is exactly same. So if you invest in futures, right, what's the difference between futures and spot? Assume there is no cost and there is no benefit. Assume that. What is the difference between futures and spot? The only difference. Can I say it's time value of money? Right?
Yes.
So. Do you remember the time value equation? PV, present value, into 1 plus R raised to T. Am I correct?
Yes.
Will give you future value, isn't it? Now that present value is nothing but I can say spot into 1 plus risk-free rate raised to T should give me the future price, isn't it? Everyone. So what is the difference that you see between the futures and spot is nothing but that is with regards to the time value of money, that is 1 plus risk-free rate raised to T. Am I correct, everyone? Yes or no?
Yes.
But now when you invest in futures, your F0 of T means future price now for let's say 3-month maturity. So that future price is spot price into 1 plus RF raised to T. That is true. But you are not going to get something when you invest in futures. What is that? I repeat, you are not going to get something in the futures. What is that?
Benefit.
The benefit. But you have an advantage that you don't have to pay for the costs. If you're holding the contract of, let's say, gold in the futures market rather than spot, you don't have to pay for the locker charges. Clear? So there is clear-cut a benefit and a cost which is not there in the futures case. That's the case only in underlying asset. Am I clear?
Yes.
Right. So from the spot, what you will do is that you will adjust this net cost of carry. Net cost of carry. Net cost is nothing but basically the adjustment of the cost and benefit. And this net of cost and carry is what we will adjust. So let's say if there is a benefit or in the form of dividend, are you going to get that dividend in the futures? Are you going to get that dividend in the futures? No. If you are holding an asset for 3 months and in between that 3 months, if the asset is expected to pay any dividends, because you are trading in the futures, will you get dividend? No. You will get dividend only if you are holding the asset in the spot. So that's the money you will lose if you are trading in the futures. So basically you will not pay for it. Are you getting my point? Correct. But if there is a storage cost, if there is a storage cost, just imagine, because you have a futures contract, are you going to pay for the storage cost?
No.
No. But the one who is committed to you to give you the asset, or the one who is holding the asset for you, will have to incur some storage cost, right?
Yes.
Let's say you are going to come to me after a month to buy the contract of crude. So I have stored the crude for you. Am I correct? So I will tell you that do pay me $100 for the current price, plus the opportunity cost for, let's say, 1 month, right? Plus the storage cost. I would ask you for the storage cost also, right? So basically we add the cost, we subtract the benefit if we are trading in the futures. Because when you're trading in the futures, you don't get the benefit. So the benefit is subtracted. Why would you pay for the benefit which you're not going to get? But you will pay for the cost which the seller incurs on your behalf. That is the storage cost. And the difference, the net of that is called the net cost of carry. Is that clear? So now for your example, let's say here, consider the risk-free asset of 5%. Spot price at the initiation of the contract is 1,000. So let's say the spot price of the asset is 1,000, current price. And the net cost of carry is 25. This may be due to some dividends. So, am I going to get these dividends? No. So why should I pay for it? So I will not pay for it. I have subtracted that present value of dividend, 25. So the net I'm going to get today, and that I have to find in the future, that value. So what is the risk-free rate? 5%. And the contract is for 1 year. So they have asked me to calculate the no-arbitrage future price. No-arbitrage future price means a theoretical or intrinsic future price, means what should be the price. So this I will multiply with 1 plus risk-free rate, that is 1.05 for 1 year. So basically I'll get 1023.75. This should be the price of the contract. Now this net cost of carry in this case can be dividend, which I'm not going to get. So why should I pay for it? So this 25 is assumed to be the present value of dividend. Is that clear? Correct. Had they told me that this 25 is the future value of dividend, then I would have taken simply spot in the future and then subtracted the dividend. Are you getting my point? Right? Then I would have taken spot multiplied by 1 plus RF raised to T minus 25. But since nothing mentioned here, we consider this 25 is the value today. Is that clear? Yes. So what is the equation here? If you notice, it's the spot price minus the net cost of carry. And as I said, the difference between the spot and future is due to the time value of money. So you compound it for the, let's say, 3 years, 1 year, or whatever the maturity is. Is that clear? So what do you notice? The future price is spot minus net cost of carry into 1 plus RF raised to T. Basically, I will now conclude future price equals to spot price minus the present value of benefit, because I'm not going to get it, plus the present value of cost, if any. Everything, this is in today's term, correct? And all of this multiply with 1 plus risk-free rate raised to T. Is that clear? It's the simplest time value of money equation, but the only two things that I've adjusted now is the benefit and the cost. The benefit I'm subtracting because when you invest in futures, you don't get dividend. So you are losing that. So why should you pay for it? Cost, you are adding it because you don't pay the cost, but the seller pays on your behalf. So the seller will add on it. Is that clear? Right?
Yes.
Everyone, this is an important element of future pricing. But here again, my focus will be on discussion of why the risk-free rate. Why am I taking RF? And now you know the reason. Why am I taking risk-free rate in the valuation of futures or forwards or derivatives, but not risk premium? And why is that so? Why is that so? Come on, tell me. Well, I've been discussing that because derivatives assumes the investors are
Risk averse.
risk averse. No, they assume investors are risk neutral. Equities, underlying asset assumes that investors are risk averse. Therefore, they expect risk premium also. But derivatives don't believe in that. Derivatives believe in hedging. Hedging means you will get risk-free return.
Fully risk-free rate.
So before I discuss anything else, let me actually come to the conclusion again of this point, right? First of all, most of the investors are risk averse. They do not accept risk without expectation of additional returns or additional, basically, risk premium. Risk aversion is relevant. It is important for pricing of underlying asset, but not for derivatives. For derivatives, we use
neutral,
risk neutral assumption, and therefore we discount it only with
risk-free rate.
So yes, we are going to discuss why do we use risk-free rate and not risk premium while doing derivatives. We are going to discuss about that. But before that, I need to discuss with you what is replication. So replication is like, what position you can take in derivatives which replicates something. For example, when you buy an asset and short a derivative like futures. So you have bought a stock and you've sold a futures on it. What is eventually you're going to get? Wherever the market goes, eventually you are completely hedged. Am I correct?
Yes.
And when you're completely hedged, your returns will never be more than risk-free rate, because that's the only difference between underlying asset and derivative, assuming everything else is not there. Am I clear?
Yes.
So your returns are going to be equal to risk-free rate. Therefore, having such a position is equivalent to investing in a risk-free bond. Are you getting my point? So having a long asset and a short derivative is equivalent to what? Is equivalent to long in a risk-free asset, that is investing in a risk-free bond. Clear?
Yes.
This is called replication. Means if you don't want to invest in a risk-free bond, take an asset and hedge it using derivative. That's it. It's more like investing in a risk-free bond. Clear? Right? Now, think of this. You are long an asset and you are short risk-free. Short risk-free means borrowing. So you've borrowed money, okay, and then put in the stock. Isn't it called leverage?
Yes.
You borrow the money and invest in stock. That's leverage, which is exactly like derivative position. Had you just taken the futures contract, you don't have to pay the full money because you are provided with the margins. Correct? So having an asset and doing a borrowing is equivalent to long derivative. Is that clear? Or so-called as a leverage position. Clear, everyone? If yes, please.
Yes.
If no,
Yes.
please ask me doubt, because this is all very important. See here, what are we going to do? A lot of students ask me, sir, derivatives, don't we have questions to solve? I say that, you know what, CFA Institute knows that you all are expert or champions in those calculations, which they will do in options. But they want you to get deeper into the fundamentals of derivatives, which at times people feel that, why are we repeating the same thing again and again and all, but that's very essential. And all these bits and points will come together when I will do eventual part of, pricing and all. Okay. So hold on for that. So now think of it. Okay. What position it is? You have an asset and you've done a borrowing. So it's like a leverage position, which is nothing like, but having a direct position in derivatives. So it replicates a long derivative contract. Clear? Right? Now think of a reverse. You have a short derivative and you have a borrowing. So you want the asset prices to go down, short derivative, and you have also done the borrowing. So when you do borrowing, you get the money now. Am I clear?
Yes.
And when you are short the derivative, you expect the market to be bearish. Clear? That is exactly like shorting an asset in the underlying. Shorting an underlying asset, when you sell an underlying asset, now you get the money and you expect the prices to go down. Is that clear?
Yes.
Right. So this represents replication. Replication is this, and that replication you can do it with the derivative. So when you take a position in underlying asset and combine it with derivative, it can replicate something. Are you getting me? So your three things are involved. Can I say which three things? Or can you tell me which
Long
three?
asset.
An underlying asset,
Yes.
derivative,
Derivative
and
and risk-free bond.
risk-free, which is borrowing or lending. So when you do the combination of these three things, you can replicate, right? You can combine any of these two things and replicate the third. Clear? Right?
Yes.
Why do we do this? Why are we doing this basically? Well, the entire reason of doing this is to find whether there is an opportunity or not. So first of all, what is replication? It is a creation of an asset or portfolio from another asset, that is derivative, right? And along with that, you also add risk-free rate. So a portfolio composed of underlying asset and the risk-free rate could be constructed, underlying asset and risk-free rate could be constructed to have exactly same cash flow as derivative. So you can combine any two and create a third one. Clear? That is called replicating a portfolio. Is that clear? Right? So if you tell me that, Kunal, I want to invest in risk-free, I can do the same thing by investing in a stock and hedging it with a derivative instrument. Is that clear? Why would I do that? Because I feel there is some opportunity there which may give me definite returns. So that opportunity can be arbitrage, that can be probably to you are stuck in the underlying asset and you want to exit it. So you want to reduce your cost or loss. So you can probably use this for various reasons. That is why people do replication. Clear? And at times replicating is cheaper than directly doing the taking the underlying asset. For example, instead of shorting the asset in the underlying, which is difficult, you can do a short derivative and you can do borrowing, right? So that depends. Of course, that's not the ultimate objective here, but the most important objective is to find the opportunity. If there is any opportunity to make money. Clear? Now, how is this connected with the concept of derivative pricing? Let's watch that. So combination of underlying asset and derivative. Out of this replicating, one of the focus will be you buy a long asset, you buy an asset, and you take a short position in that. What will be your returns? Your returns will be equal to risk-free rate. Correct? So they are saying that the entire objective of derivative was to hedge. So if you combine an underlying asset with the derivative, right, your return should be equal to risk-free rate. And if that's the case, the discounting should be equal to risk-free rate. Okay. So because of replication that we just studied, derivative pricing depends on the characteristics of underlying assets, right? The characteristics of derivatives and the risk-free rate. Three things we've combined. Investors' risk aversion is therefore not a factor in pricing derivatives. The derivative pricing models discount the expected payoff of the derivatives at what? At the risk-free rate. Is that clear? Everyone? Rather than risk-free plus risk premium. We can thus assume that investor is risk neutral with regard to derivative pricing. So all in all, a clear thing that when you're pricing equities, underlying asset, you will use risk-free plus risk premium. But when you are pricing a derivative instrument, the discounting is always and always at risk-free rate, because we assume the investors are
Risk neutral.
Neutral means that under the derivative contract, the outcome should be equal to the risk-free rate. So the conclusion is that the difference between the underlying asset and the derivative instrument is due to the risk-free rate. Clear? Which is very much logical, because the only difference between underlying and derivative is because of the time value of money. And because derivative is derived from the underlying. So if the underlying keeps changing, the derivative will also keep changing. And the only difference is time value of money. Clear? So what is risk neutral pricing? It is the process of pricing derivatives by arbitrage and risk neutrality. Arbitrage means if these equations don't match, then there is an arbitrage opportunity. If these equations don't match, there is an arbitrage opportunity. The pricing of derivatives is on the assumption that market is free of arbitrage, means there is no arbitrage opportunity, and therefore the only return that you're going to get is risk-free rate of return. Clear? But like everywhere else, what is the problem with arbitrage? We assume that there are no transaction costs, no taxes, market is completely risk-free, and unlimited borrowing and lending is allowed, right? We assume that, so some arbitrage transactions are not completely risk-free, and knowledge of volatility is a key requisite. So we assume that markets are completely risk-free, but that's not the case. Some arbitrage opportunities require short selling assets, which can be difficult. So there are some problem with arbitrage that we assume that there is no transaction costs, there is no taxes, but in reality they are. We assume that markets are completely non-volatile, or there is no interference in the market, but there is. We assume that everything is allowed, but at times short selling is prohibited in various markets. So these are practical problems, but if you ignore them, I mean, you don't ignore it for the syllabus, but just if you ignore them, then derivatives is based on the fundamental of risk-free rate of return. Is that clear? Correct. So constantly from the last 35-40 minutes, I'm yelling one point, that derivatives means discounting with risk-free rate of return. And what you just derived here was nothing but the price of the futures, right? But there's a difference between price and value. What is that? Value here means how much you will create from taking a position in derivatives. What are the positions you can take in derivatives? You can take a long or a short position, right? So if you take a long position now, let's say in the futures, you take a long position now, you just enter into the contract. Do you pay anything now?
No.
Do you pay anything? Even if the futures price is 100, do you pay 100 now?
No.
No. Does the seller get anything now?
No.
So at the initiation, when we both enter into the contract, you enter into a price, I enter into a price, that is called the price of the futures. But do we both, either of us, get anything now? No, that's called value. Clear? But will this be the case always? Which means that after today, let's say after the contract is for 3 months. So after 1 month, the overall contract is for 3 months. So after 1 month, will a position be the same? Will the price be constant?
No.
No. Either it may increase or decrease. If it increases, the long makes some money, right? And the short loses some money. Is that clear? That what you gain or lose is called value under the derivatives contract. So value is the wealth that you are going to get from the derivative instrument, that you create or you lose in the derivative instrument. But price is the price at which you and I agree to get into the contract. Are you getting this difference? So at the initiation, we both agree at the same price, correct? Do we pay any money at the initiation? No. Therefore, is there any value at the beginning of the contract? Does any of us make any gains or loss when we enter into the contract?
No.
No. So. Now, an important question. Is there a price at the initiation between you and me? Price. Yes. Because we both enter into a price, right?
Yes.
Is there any value at the initiation for either the long or short?
No.
No. None of us create any value. But later on, as the pricing of the underlying asset will change, the derivative pricing will also change, and either me or you will gain or lose something, right? So there will be gains or loss, and that assume, let's focus on the long side. So whatever is the gain that the longs will make, or the loss, whatever it is, due to the change in price later on, is called the value of the derivative contract. The value can be a gain or loss. Is that clear? Right? So value is the wealth represented by owing the derivative contract, and price is the price at which you and I agree, the long and the short, or the two parties agree to pay. They both agree to pay whenever the contract matures or whenever the contract settles. So valuation of stock and valuation of derivatives is very different. For Stocks, how do you value? You know the dividend discounting model. You estimate the future dividends and pricing, and you discount them with the cost of equity. Clear? So the fundamental value of stock can be estimated by using equity valuation models like dividend discount model. But derivative pricing is very, very different. So derivatives markets are slightly different with respect to the notion of market prices and fundamental value. We are going to deal with that. But I would like to say we are going to focus here on three derivative instruments: futures, forwards, and swaps. Options we will do later because option valuation pricing is completely different. So I'll discuss about the futures, forwards, and swap. The value of futures and forward contract at initiation is zero. Are they true? Is it true? The value or the forwards and future contract at initiation is zero. Yes or no?
Yes.
Why? Because as they do not require any initial outlay of cash and the price is a no arbitrage value for both of us. So you and I agree that this should be the price based on the demand supply or our assumptions. And we both deal in it, but we don't pay anything now. Therefore, the value at the initiation is zero. But as the price of the underlying asset changes during the life of the contract, the value of the futures or forward position may increase or decrease. If the value fluctuates thereafter, as the spot price of the underlying asset moves, and the spot price increases, what will happen to the future and forward price? They will also increase. So the long will make money. And if the prices go down, the short will make money. Clear? The contract price at which long forward will purchase the asset in the future does not change because I have booked that price with you, right? But the value will change. So what changes and what doesn't change from the day zero to day maturity? What changes?
Value changes, price does not.
Absolutely, because price is what we have booked. I have booked with you that I will buy gold from you after 3 months at $100. That's not going to change. But the underlying asset's value will keep on changing, and that will create the position beneficial or loss for me. So, very important conclusion. In the derivatives, when you enter into the contract, the price is fixed. It's not going to change, but the value may be changing either in your favor or in my favor. Is that clear? Yes.
Yes.
Now that's the case which is going to happen in forward, futures, and swaps. They have a linear payoff. Linear payoff means whatever is the gain for long is the loss
for short.
And the vice versa, right?
Yes.
And if the long can have unlimited gains, they can also have unlimited losses, and vice versa for the short. But that's not the case with options, so we are not going to discuss about options anything now. They have a very different valuation format. Options, their derivative value starts by premiums, and the entire discussion in option is about premium. So I'm not going into the option pricing now, and you shouldn't be, because we have a separate topic for options. Clear? I mean, I have a separate topic for option, not the institute. The institute has actually mixed up multiple things. What have you understood from the derivative pricing, excluding option? That dash changes, dash doesn't change.
Value changes, price doesn't.
Correct. And the value at initiation is?
Zero.
Zero. Clear? Now comes very important thing. All that we were discussing about the price and value will come. Do you remember I discussing something about the convenience yield? Convenience yield, that is the non-monetary benefit, right? So when you are holding an asset in the underlying physically, you have monetary benefit and non-monetary benefit. Monetary benefit is like dividends. You get dividends when you are holding the asset in underlying, but you don't get dividend if you are holding the asset in futures and options. Because in futures, if you're long now, by maturity, you'll be short. So eventually it will be zero. Clear? So you are actually not buying a share when you are dealing in futures and options. Clear? But if you are having an underlying asset, yes, you are holding the share. So when the company declares dividend, you also get dividend. That's a monetary benefit of holding the asset. Clear? And the non-monetary benefit, yes, the monetary and the non-monetary, I'll first discuss that. Monetary benefit is dividend or interest, which you get if you're holding the asset. Non-monetary benefit is with respect to not stocks, but with respect to commodities, right? And that is called convenience yield. However, convenience yield is difficult to measure I'll tell you how. If the asset is difficult to sell short in the market, for example, you can do short selling of a commodity, but you have to deliver the asset, right? For doing short selling. Means in order to do short selling, I should have the asset either now or I should be able to deliver it in the future. Correct?
Yes.
Because short selling means I am committing to sell it to you, right? And if you ask me for delivery, then I should have that physically with me. Clear? All right. So if an asset is difficult to sell short in the market, means it is not possible for me to deliver that asset to you, then tell me, will there be more short sellers or less? If the asset is difficult to get, to sell, will there be more sellers or less sellers?
More sellers.
But for those the more sellers, where is the asset? Think of it. What am I trying to say? That if the asset is rare, it is difficult to sell because it is not there.
Mm-hmm.
More and more people want to sell, but do they have it to sell?
No.
So the actual sellers are less in the market. Are you getting my point?
Yes.
You want to sell it.
Want to sell it, but actually we cannot
because
sell
it
it.
is not existing.
Yes.
So there are very few people who are doing short selling. And there are more people who are willing to buy. Clear? Are you getting my point? In such a case, what will happen to the price? Should the price increase or decrease?
Increase.
Increase. So anyone who is physically holding the asset will be in great demand, isn't it?
Yes.
Clear? So if an asset is difficult to sell short in the market, owning it may convey benefits in circumstances where the selling the asset is advantageous. For example, they are saying that during a shortage of the asset, maybe due to some problems of supply. Okay. So can you name me any asset which was very short in supply in the recent times? In the recent times, let's say vaccines or masks. They were initially very short in supply. Not
Yes.
everyone had that. Correct? So those who had already produced it, right? For example, Singapore had the biggest stock of mask. Are you getting my point? Because they were already producing it. They did not overnight start the production. They already were the producers of the mask. So when the pandemic came in, Singapore had the physical mask supply with them. So they were able to sell it when the demand surged drastically and they got the benefit. Clear? And then there was initially a very big shortage of masks. Then the mask came in, and then that's the case with vaccines also. Initially, the vaccine were very short in supply. They're still short in supply in many places. So the ones who created first, they got huge benefit. Clear? So all in all, I'm trying to say when the asset is rare or shortage in supply, what happens? Making a short sell is difficult. Clear? So in such a case, if you physically have that asset, you have more potential of profit, isn't it?
Yes.
Now, how much is that profit? How much you can derive? We can't calculate it. But there is some benefit of having a physical asset rather than having a derivative contract in some cases. Clear? This is called the non-monetary benefit or convenience yield. We are not going to be able to calculate the convenience yield in practical life also. And from the exam perspective also, they will never tell you to calculate something like this. They will only give you the number that this is the benefit. That benefit may come from monetary or non-monetary. You don't have to worry about it. Clear? I'm just discussing what is convenience yield. Okay. So from exam point of view, don't worry. Yes. So when the ability to look at painting or a sculpture provides non-monetary benefit to its owner, it is unlikely with corn or other commodities. They have given a very good example. So when you see a painting, do you know the world's costliest painting which was sold? I think it was sold last year, Salomon Mundi, if I recollect the name properly. That painting was sold for what price? Do you know that? That one painting,
No.
Salomon Mundi. It was sold for $490 million. $500 million. Can you believe that? Paid by His Highness, the King of Saudi, Mohammed bin Salman. Okay, for one painting, $500 million. It was auctioned in France. So $500 million for one painting. Now, you may wonder that what's there in that painting, right? What's there in the painting of Mona Lisa, right? That Mona Lisa painting, why is it so famous? If ever a bidding is done on Mona Lisa painting or a Pablo Picasso's painting, you know how much that fetches. I'm just trying to say that that's a benefit that someone gets which we don't understand, right?
Sorry, what was his name?
I think it was Salomon Mundi. I'm not exactly, I don't recollect, but something Salomon Mundi, if I'm not wrong.
I really want to see the painting.
The important thing is, you know what? Ever since that painting is taken by the Saudi prince, that painting has never come up back in the market. They somewhere have hidden it. So I've heard my friends visiting to the Louvre in Paris, and they really admire it. But then I also heard that the replication of Louvre is in Abu Dhabi, and I saw that, and it's fabulous. I was mesmerized when I went to this that museum, that art gallery of Abu Dhabi, and so fabulous it was, and all the painting and exotic arts that they have from centuries back. Most of them are in millions of dollars. So only an art lover would understand the importance of it. Okay, for us it's like, what's in there? Okay, so that's the case basically. Anyways, I just remember one thing from World War II also, when Germany captured Paris, when Hitler took over Paris, they ensured that the museums were not destroyed. So even in that World War, the art was being protected, the art was being secured. So that's, I think that's the value for art, that people who know about it, they have that value. Okay, all this are part of my CFA curriculum. So Salomon Mundi, go ahead and see that.
I saw it. I'm just seeing it.
Acha, how is it? It's good.
Maybe only the who are like artist lover would like it. I believe.
That's a convenience yield that they get. We may not understand, right? Correct. That's how it is. For us, it's just a painting, but for someone else, it's something more than that. That's a non-monetary benefit which you neither can calculate or nor can you define it. Okay, but if I tell you having a derivative contract of that painting or physically have that painting, what is better? Of course, having physically is much better.
Physically, yes.
Clear. So if I were in the place of that Saudi prince, I would also take a derivative contract on that painting and do it in the futures market. So, the price of the derivative, the painting should also be traded, because they are never going to get the physical access to that delivery, to that asset, but the pricing should be traded. So if I were at a position, I would list down all the exotic paintings and arts in the derivative market and do the long shot of that. Okay.
It might start to after a few years. Never know.
Hopefully, if Bitcoins can, why not this?
Yes.
So overall, when you are now, our focus is to price the futures and then find a value. So whenever I will price a future, it's not only now spot and that time value of money, but along with spot, now I will also adjust for the cost and benefit. Clear? So we take the present value of cost, we add it, we subtract the benefit. Why? Because we are not going to get the benefit in future. Clear? Yes. So the benefit will be subtracted from the spot, the cost will be added in the spot, and then you take it to the future. So we take the present value of cost, we add it, we subtract the present value of benefit, right? and compound everything in the future. But if you have cost and benefit both, then you adjust both together. So you have spot, you have plus the cost minus the benefit in present value terms, and then compounded with the risk-free rate. Clear? That's the pricing of futures. That is the price of the future. Is that clear?
Yes.
But the value depends on what price did you get in and what price will you exit. What price did you get in and what price do you exit? So think of a long perspective, long futures. So the price that I'm dealing with you, futures or forward, that's the price I have to pay to you if I'm a long, correct? So that's an outflow. Clear. When am I going to pay that outflow? As per the contract. If it's a 3-month contract, I'm going to pay you at the end of maturity, right?
End of the 3 months, yes.
If I pay you before that, then I have to find the present value of that. If I pay you on maturity, then that's the value I have to pay you. In return, whenever I pay you the money, I will get what? I will get the asset physically delivered, and I will sell that asset in the market, and I will get the spot price on that day. Now, how is the value derived? This formula right now, you may not understand, and the pricing also you may not understand unless and until I do some questions. So now let me go to the questions and then discuss everything else. But before I go to the question and before I discuss this particular sheet that you see here, some minor things that you need to understand is a terminology. Can you read all this terminology, please, quickly for me? Yes. What is the bigger T? That sounds for?
For maturity.
For maturity. The smaller T is for?
Time before maturity.
It can be any time before maturity. Then you have V is for value. S0 is for?
Spot price.
Spot price. Then you have forward price, risk-free rate. And then you have this Greek letters called gamma. Gamma and theta. Gamma is for the benefits, which can be monetary and non-monetary. And theta is for the cost. Is that clear?
Yes.
So gamma and theta are the two important things. Now let me take you to the forward valuation. We will start with the pricing and then we will go to the valuation. So what is the situation here? The value of today of the stock is 1000. That is S0. Risk-free rate is 10%. Maturity is 12 months. Spot after 3 months is 1050. F0T is 1100 and on maturity the price is 1130. Do you recollect something from the concept of convergence which I discussed in the previous topic? Convergence. Do you recollect something? What happens on the last day? On the last day, yes. On the maturity, the spot and the future price both should be same because there's no time value of money left. Remember that? Correct?
Yes.
So here, what I will first do is that I will put everything into a timeline. Because without timeline, we don't solve anything. That's what we've learned from quants also, right? The time value of money. So all that you see here, you have to tell me what situation is happening. It's a 12-month contract. Am I clear? What is the value of asset today? That is the spot price, right? Spot price today. Can you tell me?
1000.
1000. So I will write on day 0, I will write here spot price equals to 1000. And on that day, when you enter into the contract, the future price on that day is how much? 1100.
1100.
This price will not change because that's the price at which you and I have booked the contract. Clear? After 3 months, the spot on that day is how much?
1050.
1050. But the future at which you and I had booked the contract, that won't change. How much is that?
1100.
That is fixed, right? And on the last day, they've given me some price. What is the last day price? That is on maturity, ST on maturity, and my future price is fixed. That's not going to change. But on last day, they've given me the future price, which is also the spot price, right? Which is how much?
1130.
1130. Clear. These are the prices that they've given to me. Now, what is the value? The value, how do I find the value? What is the spot price now?
1000.
1000. Clear. Now, 1000 is the price now, but of that 1000, what do I have to do? I have to, if I settle the contract today itself, how much will I be paying? See, I will tell you. I will be paying the present value of the future price, which means I will be paying how much on maturity? I was supposed to pay how much? 1100. Clear?
Mm-hmm.
But what is the present value of that 1100 now? If I pay it now, how much am I paying? What is the 10% discounting rate for 1 year? So if I do that, divide by 1.1, that's the money. So I will be paying the present value of 1100 now, and I will get an asset which I sell in the market today. It will be sold at 1000, right? So what will I make? Eventually nothing. Are you getting my point? So I'll just change the formula here. It is S0 minus present value of present value of future price, which is nothing but F0T divided by 1 plus risk-free rate. Clear? Now, why is it 0? Because if you right now enter into the contract and you immediately sell it, will you get anything?
Nothing.
Nothing, because the difference between the spot and the future price is just because of time value of money. So if you take the present value of the future now, you settle the contract at initiation, the value is always 0. Clear?
Yes.
But later on, your future price is fixed, but your underlying will keep on changing. So what happens after 3 months? After 3 months, what is the spot price in the market?
1050.
And the future price that you have booked is how much? 1100. But you are going to pay that 1100 after 3 months from now, which I can say is 9 months early.
9 months.
Correct? Very good.
Yes.
So now I will do 1.1 raised to 9 divided by 12, right? In the above part, I did raised to 1 because that was entire year. So in your calculator, do 1100 divided by 1.1 raised to 9 by 12. So how are you going to do that? First, press 1.1. In your calculator, press 1.1. Yes. Done?
Yes.
Now do raised to 9 by 12 is 0.75. So you can directly do 0.75. Or you can do 9 divided by 12 and then equal to. So anything is fine. So now press y by x 0.75 equal to. You'll get 1.074. Correct?
Yes.
Inverse it and multiply with 1100.
1024.
Correct?
1.
Now, subtract 1050 from it, you will get 25.88.
Yes.
Correct? That's the value you will get when you settle the contract after 3 months. Clear? So at any time, the value is the difference between the spot and the present value of future. The present value of the future, depending on when you're settling the futures. If you're settling 9 months earlier, take the discounting by 9 months. If you're settling today, then take the discounting for entire duration. Clear? If I settle the contract on maturity, if I settle the contract on the last day, what will be the situation? What is the spot on the last day? 1130 minus the present value of future. On the last day, the future I have to pay is 1100, right? I don't have to discount it. Are you getting my point?
Yes.
So in such a case, the value is 30. So you see here, the value is increasing for the long all the time. Why? Because the underlying asset is increasing. So what is value? Value is the difference between the price at which you settle the contract in the price at which you enter into the contract. That the difference between them is the value. Clear? But one thing is for sure, at initiation, the value is always and always, what?
Zero.
Zero. If you look out the MCQ which I've put here, the concept is the price of a forward or a future contract, or even for that matter, swaps. They are all type of forwards only. Is always zero at initiation. Am I clear? But the value of the contract is always zero at initiation, but not the price. The price
Remains the same.
If they say value, it's zero. The price will change.
Remains same.
It will
Remain same.
Correct. So if they ask me your value, then my answer is A. If they ask me price, I will say it will remain same over the contract. Clear?
Yes.
So the price of the forward or futures contract will always remain the same, irrespective of wherever the underlying goes. Yes, but the value, if they ask me the value is at initiation is zero, not the price. Clear?
Yes.
The next question, the underlying asset of a derivative is most likely to have a convenience yield. When convenience yield is possible, when you have three choices. It is difficult to sell short, pays interest or dividends, must be stored and insured.
Must be stored and insured.
No, must be stored and insured is related to storage, which is a cost. Pays interest or dividend is monetary benefit.
Monetary benefit.
And when it is difficult to do short sell, it's a non-monetary benefit, which is convenience.
Convenience.
Okay, so sorry, this thing is going up and down. So A is the answer. Clear? Yes.
Yes.
So now, what is the value here? Check it out. The value formula. See this. The value is nothing but spot minus the present value of the future, depending on present value of the future, depending on whenever you're settling the future. If you're settling it today, we discounted that with the entire maturity, which is always zero, isn't it?
Yes.
But during the life, the value will keep on changing. Now here, I did not add the benefit and the cost. If I adjust the benefit and the cost, what do I have to do with the benefit? I have to subtract the benefit. The benefit here, gamma, is what I have to subtract. The cost is what I will add, right? And that present value of it, everything, take it in the future. Everything, then take it in the future. Subtract it from the price of the future, depending on when you're settling it down. On maturity, there is no benefit or cost. Why? On maturity, on the last day, on maturity, you don't have to worry about the dividend or the cost, because you're not going to pay anything, or you're not going to receive anything on maturity. Clear? So if the company hasn't announced dividend till the last day, that means you will not get any dividend, right?
Yes.
So on maturity, the difference is only between the spot price on that day and the future price which you had booked. Is that clear?
Yes.
Now that difference can be gain and loss during the life of the contract, but at initiation it's always zero. So for the long forward, at time zero, it is spot minus the present value of dividend, if there is, and minus the present value of future contract. If there is no dividend, it's just the difference between the spot today and the present value of futures. On maturity, it is the spot on that day and the future price which you had already booked. And during the life, the gains and loss can be there for either of the contract. Clear? Now I'll take one more example where you will understand this at much length. And then probably after this example, there will never be any doubt with regards to the pricing or the valuation. So what's the situation here? Calculate the no-arbitrage forward price on a stock. No-arbitrage forward price on a stock. If it trades at 100 today in the spot, expected to pay dividend in 10 in 25 days, 12 in 80 days, and 20 in 120 days from now. Wow, very interesting. So if we make the timeline here, what is the situation that we have? What is the maturity of the contract? Maturity of the contract is
100
100
days.
days, right? At the last they have mentioned it. So now I will just put here things. So first is 0 and then you have 100 days. Clear? So today, what is the price of the asset today? Today, spot is 100. And then you get dividend in 25 days. First dividend. Second dividend you get in 80 days. And the third dividend you get in 120 days. Is that concern for me?
No.
No, we are not going to include the dividend which is after maturity. We are going to ignore that. Is that clear? They have asked me for value of the forward at today at t equals to 60, which should be somewhere here, then at 85, and then on 100th day. Basically, all the doubts that you have about the futures or with regards to the valuation or price, everything will be handled at this point. Now, what am I going to do is that I'm going to keep on writing the information which is given to me. So what is the information that I have here? Well, they have said me that the stock trades. So S0 is
100.
And the dividend here the dividend, expected dividend is $10. Here the expected dividend is $20. The risk-free rate is 5%. And they have told me
$12.
calculate the value of forward at time $12. No, I don't have to take the $12. Oh, sorry, $12, right. The 80th day, right? Sorry, my mistake. This is $12, right? Correct. And the 20th after 120, that we don't have to take, right? Now they have said me that calculate the value of forward at time 0, at time 60, when the spot on that day is 125. So on the 60th day, can I say on this day, the spot is 125. On the 85th day, they have said that the spot is
140.
And on the last day, ST I will write is 150. This is first very important thing that you just have to write down all the information. You have to write down all the information. Is that clear?
Yes.
Now, what is the situation? What is the first thing that I need to come up with? I need to come up with the forward price, isn't it? I need to first will have to find the price of the forward, which will be same for all the maturity, right? Because prices don't change. Am I correct? So I have to find the forward price, correct? Have they given me that forward price, by the way? Have they given me the forward price? No.
No.
But you know how to calculate forward price? Yes. How do we calculate the forward price? Forward price is nothing but the difference between the spot is because of time value of money. But here you also have the dividends, right? So you have two dividends. How many? 10 and 12. You need to first find the present value of these dividends. How will I find? 10, 10, 10. So guys, tell me 10. I have to bring 10 how many times back? Discounted with the risk-free rate, which is 5%. But for how many days?
25
days out of the total 365 days. So I'll discount it 1.05 raised to 25 divided by 365 to make it to the present value. Okay. Plus there is another dividend of 12, which will be discounted by 1.05 raised to how many days?
60. So 80
days. So it will be 80 divided by 365. Are you getting it? Now, how are you going to do in your calculator first? So first thing first, you will do 1.05 raised to. Now, there are two ways. A lot of people do 25 divided by 365, but that can end up into a problem. So what you should do 1.05, press y by x. Done that?
Yes. Yes.
Now, press the bracket, the open bracket sign above 7. 25 divide by 365 and close the bracket and press equal to. Tell me what is the value that you get?
1.00335.
Correct. Store it, store 1. Put store 1. Okay. Now do it for the second one. 1.05 y by x bracket open 80 divided by 365 bracket close equal to, and let me know what is the value that you get.
1.01075.
Store 2. Put that store 2. Okay. Now press 10 divide by recall 1. Store as 4. Store 4. And put 12 divided by recall 2. Put store 5. Add recall 4 and recall 5. You should get somewhere around 21.8
21.84
or 84. Clear?
Yes.
Round it off. That's the present value of your dividends, which you have to subtract from the spot. What is the spot today? Spot today is 100 minus 21.84. That's the present value of dividends. So I have S0 minus the present value of dividends. See here, how do we get the pricing? Spot minus present value of dividends, correct? Right? That's the pricing, not the value. We are not focusing on value. So I have spot minus the present value of the dividends. Is that clear? This one.
Yes. I wanted to ask you, so the days, it is 825 by 365. We don't take it 100.
So you okay. So you are not, see, what is present value, by the way? Present value is the value from not maturity. It's from the last. So if you recollect here in this example that we did, what did I do here? The maturity was 1 year, correct?
Yes. Yes.
And therefore it looked for you as same. But I want to bring something today. And the rate of interest is always annualized. It's for 1 year. Clear?
Yes.
Now in this question, the maturity and the rate both were annualized. Here also the rate of interest is always annualized. So it's 5% for full year, not for 100 days.
Okay. Yes, got it.
Bring, yeah, back for, but the discounting will always be yearly basis. Okay.
Yes.
Clear? Now, what were we discussing? We were discussing about the pricing. The pricing is always spot minus the present value of dividend and then take everything in the future. So I'll just actually now discuss what do we do. What are we trying to find? See here. We are trying to find the future price, right? So assume there is no dividend. So there is a spot and you have to find the future price. So what will you do? You'll compound that with 1 plus RF and you'll get a future price. Am I clear? 1 plus RF raised to T, correct?
Yes.
But if you have dividend somewhere between, let's say if you have dividend here. Now, are you going to get dividend? No. So you have to subtract it, right? Correct?
Yes.
Now there are two ways of adjusting it. First, you have to take everything in the future. So the first way is to bring the dividend to the present. Subtract it from the spot and then take everything in the future. That is one way, which is this. I bring the dividend to the present, subtract it from the spot and then take everything in the future. Are you getting it?
Yes.
This is one way. What is the other way? Take the dividend in the future and then subtract it from the future spot. So I first take the spot in the future and subtract the dividend at the last. Both ways will give you the same answer. So there are two ways of adjusting the dividend, which is in the middle. Either bring it to the present, subtract from the spot, and then take everything in the future. Clear?
Yes.
Or the other ways, take everything in the future and then subtract. Are you getting it?
Yes.
So what have we done here? We've taken the dividends in the present, subtracted from the spot, and then whatever is the net, take this in the future. How much future I have to take now? 1.05, but I don't have to take for entire year. What is my maturity?
100.
100. So I'm going to take only 100 divided by 365. Are you getting it? If it was for full year, then I would have just taken 1.05. Clear?
Yes. Yes.
So that's going to give me 79.21. Just verify that. Just do 100 minus 21.84 in your calculator. Store it. Store 1. And then do 1.05 raised to 100, bracket open, 100 divided by 365, bracket close, multiply with recall 1. You will get this answer, 79.2118. Is that clear?
Yes.
Now, this should be your future price. What should be your future price? It is, which is not going to change, which is 79.21. Are you getting? This will not change. Clear. Based on this, we will find the value at different point of time. Are you getting me? Clear. Now, we are always finding the value for long position, assuming everything is long. So how do you find the value? Value is the difference between the spot and the forward. Yes or no?
Yes.
So how do you find the value at the initiation? It should be spot minus the present value of the future that you have to pay. But if there is a benefit or cost, you have to adjust that as well. Correct? So what is the present value? 100.
100.
Minus. What is there a benefit? Yes, we have a benefit of dividend. What is the present value of that? 21.84. Minus, I'm going to do the present value of the future. What is the present value of the future? 79.2118. This I will divide it by this. I was supposed to pay after 100 days. So if I have to pay now, how much will I have to pay now? The present value of this. What is the present value of this? 1.05 raised to this. Correct? Right? What should this value be? At initiation, the value of future should be 0. If you calculate this, it will always be 0. Clear? So I know for a fact that irrespective of anything, the value of the contract at initiation is always 0. That's how we got the future price, isn't it? Yes or no?
Yes.
This should by default be 0. But later on, since the future price is fixed and the spot is changing, the values may change. So on 125th, on 60th day, the spot is 125. But how many dividends are you left with now?
1.
One dividend, that is how much? 12. Just check out. On the you are on the 60th day. Yes. You have only one dividend. So I will do 1.05. And how much should I bring it back? See, you are at 60. How much days you should bring it back? You have
20.
20 days back. Correct. So my equation will be 20 divided by 365. Put that into your calculator and let me know what's your answer. Now you know how to do that. 1.05 raised to bracket open 20 divided by 365 bracket close equal to inverse it, multiply with 12. We'll get 11.97. I'll just round it off.
Yes.
Now check out my value. What is the spot on that day? 125. Minus the dividend 11.97, which I'm not going to get. Right? Minus the present value of the future. See the present value of the future. Now, interesting thing. I will take this equation, but I will discount it with how many days? Depends where you are and where you are coming. Where is your future? Where is your future price? When are you supposed to pay the future price?
On 88th day. No, 100.
Tell me.
On maturity.
That is
100.
100A. So how many days are you coming back? Are you coming back 20 days
40.
or 40 days?
40 days.
Absolutely superb. So I'm going to discount the future price with 40 days.
40.
Is that clear? Getting the logic? Without timeline, you cannot solve any of the time value equations. You will get lost if you don't do the timeline. Are you getting my point?
Yes.
Now, go ahead and definitely this answer should be different from 0, right? Because
Yes.
the underlyings have changed. And since the underlying has increased, this should be positive. Find and let me know what is the value. First, you will find the present value of this 79.2118 divided by 1.05 raised to 40 by 360. You will first calculate this, store it somewhere, then do 125 minus 11.97 minus this. Check out, your value should be somewhere around 34.24. It should be somewhere around 34.24.
Yes, 34.241.
Correct. So here my value is 34.24. Clear? What is changing? What is not changing?
Value is changing.
The price is not.
Price is not.
This is the difference between value and price. Now, on the 85th day, they also want me to find the value on 85th day. So on 85th day, how many dividends are remaining?
Nothing.
Nothing. So the present value of dividend should be 0. On that day, they've said that the spot price is 140. So what will be my equation now? See, my equation will be the same. I will, instead of 125, I will take 140.
140.
And there is no dividend, so I will not take this into consideration. And I will, how many days I will bring back from, I am on 100th day, my future price. I have to come
15.
back how many days?
15.
15 days. So my discounting will be only for 15 days. Clear?
Yes.
So I will do this raised to 15 divided by 365. Clear? Just calculate that and you should get this price 60.95 approximately. Just check it. I'm not showing you the operations of calculator, which we have done already in time value of money.
Yes, 6.9469.
Now, if you recollect, the reason I did time value of money so intense, so that you don't get stuck in the calculation part here. Otherwise, your focus will get drifted.
Yes.
Now, on 100th day, the spot is 150. First of all, will there be a dividend? No.
No.
So the spot is 150 minus the future. Do I have to take the present value of the future? No.
No.
It's the last day. So that will be 70.78 or 79. Clear? So I'll just write 70.8. 70.78 it is, right? I'll take 70.79. 70.79. Clear? See this. 70.79. So what was my value at initiation? At initiation, it was 0. Correct? Value at initiation of any forward contract is 0, right? On 60th day, my spot was 125. My price was fixed and my value was 34.240. Clear? On 85th day, my underlying asset went to 140. My value became 60 point this. And on the last day, my value was 70 point this. Is that clear? Right? This is much like the same value can be for forward or futures. For future, we can say it's a mark to market. Every day or every different days, you're marking it. Who makes how much? Here, the long is making money because the prices are going up. So whatever is a value for long, the opposite is for the short. It's just the difference in sign. Now take a look completely from the scratch. Now all the formulas which we did previously will now make sense. So the price, how did we derive the price? Spot minus the present value of dividend, right? Take everything into the future using time value of money. That's the price of the future. Once you fixed the price of future, that is fixed. So at initiation, the value is always 0, but later on, either of the party will make money. So we discovered the price at different dates. Instead of taking 3 or 4 sums, I've clubbed everything into one sum. Is that clear?
Yes. If we are taking, as you said, that there are 2 methods of doing this.
What 2 methods? Sorry.
Like dividend, taking it with the spot.
You'll still get the same price. Exactly.
No. But how many days? Only will be the difference in the days when we are calculating.
Okay. Now I think this is the problem with your time value of money. Tell me one thing. If okay, let me explain it, because I need to correct this, and this is because I'm sorry, but this is because lack of practice. Now, time value of money, if I play with time, it doesn't change. What is my forward price? 100 minus present value of this dividend. If you don't take the present value of dividend, take 100. Okay. 100 in the future. So take 100. First of all, calculate this. 1.05 raised to 100 divided by 365. Put that into the calculator.
Yes.
Right?
Yeah.
That store one. And multiply that with 100. Multiply that with 100. And now again store one. Okay. Let me know what is that answer.
102.70.
Okay. You've stored it, right?
Yes.
Now, instead of taking present value of dividend, let's take it to the future. So you will now do 1.05 multiply with how many days? 75 days ahead.
Yeah. That I know the value was same. I was just asking you that the days will be different, right?
Well, that's very natural, Deepthi.
Yeah.
How can it be the same? Either you come back 25 days or you go ahead 75 days.
Sorry. I know it was very silly question, but
no, it's not about, see, silly questions are not, there's nothing like silly question or difficult question. The important thing that I've been saying to every student here is from day 0, that if you get stuck, you have to watch the timeline. You know, I may there for one sum or 100 sums, but I will not be there with you forever. And it's the timeline which will help you where you are and where you want to go. So now if you take the dividends in the future from 200 days, you'll have to compound them, not discount them. Compound them for 25 days. The second dividend, which is on 80th day, you'll have to compound it for 20 days.
Yes.
And then whatever is the future value of dividend, subtract that from the recall one that you did. You'll get exactly same answer.
Okay.
And that's the reason why now, see this, there are 2 ways of doing it, right? One is, as I said, either bring everything to the present and then take to the future, or take everything in the future and then subtract. Exactly, you'll get the same answer. Don't worry.
Okay.
Okay.
Yes.
So mostly pricing of the future will not be an issue. The valuation will be. So now I'll actually take to the slide where everything is mentioned. So here you see what is the pricing. The pricing is spot. Here, if you have the benefit, subtract it. If you have the cost, add it.
Add it.
In the spot. Adjust everything and then take everything in the future by compounding. Clear? So we have taken just the dividend, but in reality, if it's spot, add the cost, subtract the benefit, present value of both, right? Then take the everything into the multiply and compound it to the risk-free rate and take it into the future. Clear?
Yes.
This is all pricing of the forward. Valuation depends on spot minus the present value of benefit or the present value of cost is what you will add. This is today. Minus, this is the spot. For the long, if the long has the asset now, the long will get the benefit, right? But the long will also have to manage with the costs. So we adjust that into the spot right now and take the future present value of the future, which you had to pay on maturity. If you're paying it earlier, you take the present value of it. On maturity, there is no cost and no benefit. So there's only the difference between the spot on that day and the future price which you had booked initially. Clear? I have not taken at initiation. At initiation, the value is always zero.
Zero.
Clear?
Yes.
Now, the same thing here. See, what is the situation? Now, this should be very much clear. What will happen? Again, spot minus the present value of futures, right? Which is always zero. Spot minus the value of the future depending on where you are calculating. If you're calculating in between, just discount it in between. If there is a cost and benefit, adjust it from the spot, then take everything into the future and adjust it with the future price. So that's what you can do during the life of the contract, right? Now, if there is no cost and benefit, then the difference is only between the spot and the future price. Clear? At any time, if you don't want to get mixed up into these formulas, you know what? I just tell students, ignore all this thing. Just focus one thing. Spot minus the present value of dividends, right? Minus from that, you will do the minus the present value of the future price, right? That's the thing. On any point of time. Spot on that day, minus the present value of benefit, minus the present value of futures. If it is stock, you will never have cost. If it is commodities, you'll never have dividends. So mostly I'm expecting in exam either to have dividends or storage cost, right? But in commodities, you don't have dividends. And in stocks, you don't have storage cost. So mostly you'll get either of the things. Clear? Makes sense?
Yes. Yes.
Right. This one sum should do your job for pricing and valuation completely. Is that clear? Definitely, when you do written practice, I would suggest you to ensure that you don't do any error. I would suggest you to do the timeline by yourself, put up the equation and then do the calculation. Remember my technique of time value of money. Timeline, equation, then calculation. That's my TEC technique, right? I've done a copyright of it, by the way. So, but that's, I feel that is the only process through which you will never commit an error. And that's the flow. First make a timeline, then just play with it. Frame the equation and then touch your calculator. Before that, do not touch your calculator. Okay. Just imagine how much valuable time value of money is. That's in quants, equity, corporate, fixed income, derivatives, and generally in life. Okay. So without time value of money, your 5 subjects are in limbo. Okay. This is the entire reason when I do time value of money at so length. I have a lot of students saying me that why so much of detail? And I always remind them that, you know, this is all going to be helpful in the future, in the future, in the future. I actually mean in the futures and derivatives also. So that's a hint there. Complicated joke, leave it. Now, is there a difference between the pricing of forward and future? Well, not exactly. They both are same. The only thing is that forward and futures are same, but the only difference majorly is due to some factors where the rules of the exchange comes to play in the futures market. So whatever the valuation that you did here, valuation and pricing, they are exactly same for whether it's a forward or future. Okay, so we don't have a separate pricing for forward and a separate for future. It's the same. There are only some differences which we are going to see. What are those? Can you tell me before I go ahead, what will be those? Mostly they are related with the exchange rules.
Exchange.
Okay. So remember in forwards, you don't do mark to market, but in futures, you have to do every day. That's the exchange rule, right? So the pattern of cash flow in future contract is similar to the forward, right? But futures are, however, mark to market on a daily basis. Remember that? Correct? Yes? No?
Yes.
We did the margin calculation. You have to do daily,
Daily.
right? You have to present this accounting daily, which is not the case in forwards, right? The value of the future contract is therefore whatever is a gain or loss that has to be settled down on a daily basis. The value is then paid out daily into the account. The future price thereafter gets effectively reset to the settlement price and the value of the contract becomes zero. So. Very interesting thing. In forward, the valuation at the initiation is only zero, right? But in future, the value after settlement, which happens every day, becomes zero. Are you understanding that? Why? Are you understanding that why? Because in the futures, after the payment of gains and losses, nothing is left till that day. Every day the account is settled. Clear? So all the gains and losses are adjusted on a daily basis. And after that adjustment, the value again becomes zero. Clear? That's only and only because the future contracts are settled daily. The value is then paid out daily into the account. The future prices thereafter gets effectively reset to the settlement price and the value of the contract becomes zero. This is in futures. However, gains and losses on forward contracts are realized only at expiration. In forward, the settlement happens on a daily basis? No, it happens only on maturity. So the settlement, the gain or loss is going to happen only on maturity. In futures, that happens on a daily basis. So the value of the futures on daily basis after settlement is dash. What? Zero.
No.
But not in forward. In forward, you have gains or losses because the settlement is going to happen on the last day.
Maturity.
Clear?
Yes.
Now here an important assumption is that there are no cash flows in the between and the interest rate remains constant. But if these two assumptions change, that if there is a cash flow in between like dividends or coupons, and if the interest rates change, then there will be a problem. So we assume that the interim cash flows are adjusted. There's the interim cash flows or dividends or coupons will be adjusted, and then they don't make any big difference. And we also assume that the interest rate remains constant, right? But if there is an interest rate volatility, that there are changes in interest rates, then there is a problem. Why is the problem? Because the calculation of forward price that you did was based on some interest rates, right? You assume that this interest rate will remain constant till the maturity. But between that, if the interest rates change, then your valuation will also change. How? But the interest rate volatility affects the future prices as compared to the forward prices. Why? Forward price doesn't get affected, but future prices do. Can you tell me
because
why?
Of the daily settlement.
Correct. Because the settlement happens daily. In forward, it's not going to affect because the settlement is only going to happen on maturity, right? This is due to the receipt of interim cash flows on a daily basis in the case of futures because they are settled on a daily basis. If the future prices and the interest rates are uncorrelated, means if there's no relation between the prices of the futures contract and the interest rate, then can I say that prices are not affected by interest rates? So then the outcome for futures and forward will be same. Are you getting me? So if the future prices and interest rates are uncorrelated, the forward and the future price will remain the same. But if the future prices are vulnerable to the interest rates, then the forwards may not change, but the futures will change. Correct? So if the future prices are positively correlated with interest rate, then from a long perspective, the futures contract are more desirable. Why? Because the future price will keep on increasing, but the forward will not change. Is that clear or not?
Yes.
So every day I'm going to do the recalculation of the future price under futures, because that settlement happens on a daily basis. So on a daily basis, when I will recalculate the future price, I will consider that day's interest rates, which doesn't happen in the forward case because the settlement is only on maturity. So if the interest rates are constant, there's no problem. But if the interest rates are increasing, and if the future price is dependent on the interest rates, then the prices may also change. Therefore, if you expect the interest rates to change, what is beneficial to have? A futures contract or a forward contract from the long perspective? Well, it is
Forward.
beneficial to have a futures contract. Why?
Oh,
Because
because it takes the interest rate into.
yes, so the prices will keep on changing for the futures, but not for the forward. The forward prices are constant. The future prices, if they are related with the interest rates, they will keep on changing because of the daily settlement. Is that clear? Correct?
Yes.
So again, if the interest rates are changing, what is better? Having a
Future.
futures contract is better. Long futures contract is better because there is a possibility that the future prices will keep on increasing. If you have a forward contract, it is unaffected. All because of daily settlement. Clear?
Yes.
That's the only difference between forward and future prices. Otherwise, there is no difference. Now, we've discussed about swaps. Can you tell me quickly what is a plain vanilla swap? A typical plain vanilla swap, yes. Swap is like an agreement between two people, right? A buyer and a swap, a borrower, and both can be borrowers, right? They just exchange their positions. So under a plain vanilla swap, what happens? A fixed rate borrower converts their liability into floating rate, and the floating rate guy converts his liability or her liability into a fixed rate.
Fixed rate.
Right? Correct? You with the help of swap. So let's say in a 1-year swap, there are quarterly payments. So every quarter, you and I will sit together, see where the interest rates are, and whatever is the difference, either you will pay me or I will pay you, right? Clear? Remember that from the swaps?
Yes.
So swap is a series of forward or future contract. Where why do I say series? Because in 1 year, there are 4 quarters. So 4 times we will exchange the cash flows, either you or I. Correct? Now, in swaps, both of us will have to decide. Both of us will, not both of us, basically either of us will pay to one another on the settlement date. Correct? Very much like futures and forward. When the underlying assets change, one of the party, long or short, will get or will have to pay, right, on maturity. Correct? You're also in the swap, also it works exactly like same. But remember, in swap, like in forward and future, the difference is on net basis. Why is it called net basis? Because we are just going to exchange the net interest change, not the entire interest rate. So it's not going to happen that I'll give you 10, you give me 8. Instead of that, we'll just exchange the difference of 2%. Correct? Right? Yes or no? Everyone?
Yes.
So this is what we discussed in the swaps. Now we are going to understand the pricing of the swap. Now the pricing of the swap is very, very important, and that depends on what is your estimation of the future rates of the interest rates. Okay. So the net cost of carry determines the forward pricing. Since the cost of carry depends on the time interval under consideration, the price of the different implicit forwards contracts embedded within a swap also vary and will not be equal. Now, what is that? Now, let me tell you. In a typical swap, let's say if it's a 1-year quarterly swap, okay. Tell me one thing. How many payments are there?
4.
4, right? Let's say 3 months, 6 months, 9 months, and 12 months. Clear? So today, when you and I enter into the swap, let's say I'm going to pay you fixed and you are going to pay me floating, correct? So those floatings depend on what will be the LIBOR for the next 3 months, for 3 months after 3 months, for 3 months after 6 months, and for 3 months after 9 months, isn't it? So basically I need to predict what? I have to predict the future quarterly rates, forward rates, isn't it? Yes or no?
Yes.
Do you know how to predict that? We've done that in fixed income.
Yes. Spot curve. Yes.
To predict this forward rates, I need the spot rate for 6 months, the spot rate for 3 months, and I can predict the 3-month forward after 3 months. Correct?
Yes.
Now, I must have predicted something, and you must have also predicted something. And based on our expectations, today we will decide, because we don't know the future LIBORs, but we will decide what is the fixed rate that we both agree at. That fixed rate with which we both agree at, we may not have randomly calculated it. We must have calculated using our assumptions of the spot rates, right? Using our assumption of the future rates, forward rates from the spot rates. Am I clear? So. The rate that you and I decide today to enter, one of you, like let's say you will pay me floating rates, right? Against that, I will pay you a fixed rate, correct? That fixed rate is called swap fixed rate. How must have we both agreed to this rate? With the help of forward pricing or forward calculation of interest rates, which we did in fixed income, called as pure expectation theory. So we require the spot rates to find the forward rates, and based on the forward rates, you and I will agree today at a fixed rate that is called swap fixed rate. Is that clear? The rate will be such that if we both enter today into that, what will be the value at initiation? For any contract in forward, the value at initiation is always zero at initiation, but later on, it may be positive or negative. Clear? If we both agree exactly at the forward rate, which you and I have calculated using expectation, and if your and my expectations are same, then the value is definitely zero at initiation. But these expectations may or may not be true. Okay, may or may not be same. So it is possible to find a swap price where the combined value would be zero, that price which determines the swap pricing. So if you and I agree that this should be the forward rates, let's say based on the spot rate of the treasury, we both agree that these are the perfect rates. And based on that, we calculate the forward rates. And on that basis, we both agree at a fixed rate today. Then the value at initiation is zero. But after 3 months, it is not necessary that the rates will be same as per our expectations. It may be something else, right? In that case, if the rates go beyond expectations, then either of us will make gains or loss. Clear? So like forwards and futures for stocks, the value at initiation under the swap is also possible to be zero. And going ahead, this value will be in either of us favor. Clear? Now, do you know what is replication? We heard about replication, right? In the stocks. How do we replicate in a swap? So in a swap, let's say you are a fixed rate payer. So you pay fixed and you receive floating, correct? Right? In a swap, you pay fixed and receive floating, or you receive fixed and pay floating, right? Correct? So tell me one thing. If you are a fixed rate payer, can I say that means you have invested in a bond or borrowed a bond, borrowed money through a bond? When you are a fixed rate payer, pay. Have you invested in a bond or you've borrowed? No idea.
Okay.
When you pay, when you pay fixed rate, what happens in a swap? In a swap, you pay something and you receive something, right? In a plain vanilla swap, I'll repeat,
Yes.
you pay something and you receive something.
Receive something.
So when you pay, it is like issuing a bond or investing in a bond. When do you pay? When you invest in a
Investing
bond.
in a bond. Sorry, issuing. Sorry.
Issue a
Issue a
bond,
bond. Yes, issue a bond.
you pay the interests. When
Yes.
you invest in a bond, you receive interest, right?
Receive the interest. Yes.
So here, see this. See, these are all small words, which if you read also, you can understand, but it may end up into confusion. So it's okay to be confused. Don't worry. So here they are saying, if you invest in a variable bond, you will receive LIBORs. Am I correct?
Yes.
Can I say it's like receiving floating? So you will receive floating. And if you issue a bond at fixed, so you have two bonds now. In one bond, you have invested. Therefore, you get floating.
Floating.
But another bond you have issued where you pay fixed. If you have these two bonds, one where you have invested and one where you have issued, then it's very much like a swap, isn't it?
Yes.
So that replicates a swap. See that. Now read, can you read these 2 points? Yes, go ahead.
If you invest in a variable rate bond, you expect to receive a series of unknown payments in future.
Correct. That's like receiving a floating rate.
Floating rate.
Right. And then
you can finance the purchase by issuing a bond with equal fixed payments. This strategy effectively replicates the swap.
Yes. So swap can be replicated by how? By borrowing money, by issuing a fixed rate bond and investing that in a floating rate. Then it's like pay fixed, receive float. And in this transaction, whatever you gain or lose, based on that, you can find the pricing of the swap. Are you getting me?
Yes.
If you don't make any gains or loss, then the fixed rate at which you issued the bond matches the future floating rate payments, isn't it?
Yes.
That rate is called the price of the futures in the swap. That is called the swap price, or that is called the swap fixed rate. Clear? So the rate which matches your fixed payment and the floating amount that you're going to receive in a bond, that is called the swap fixed rate. Is that clear?
Yes.
So now read this 2 point. Replication assists in
replication assists in valuing a swap through it is not necessary to create the swap itself.
So I don't want to create a swap. I mean, I don't want to do replication to make a swap. For swap, I can directly deal with an investment banker. But the price of that swap should be equal to the replication strategy where I issue a fixed rate bond and I receive floating rate bond interest. It is therefore possible to value a swap based on the replication and the principles of no arbitrage, which means the entire world is doing this. So whatever is the fixed rate against those future uncertain interest rates of LIBOR or any reference rate, that is called the swap fixed rate. So it's not easy, but it's not impossible to determine what should be the swap fixed rate at which you and I will agree. Is that clear?
Yes.
Well, that's it. This is how and where we have understood different concepts of derivative, especially the risk neutral, where we discount everything with the risk-free rate was very, very essential. Then we determine the price of the future, which is spot minus any benefit, add any cost, and take everything into the future using the risk-free rate. Why risk-free rate is what we discussed, because we assume the investors are risk neutral. And then we understood the difference between price and valuation. The price remains constant, but the value keeps on changing, and that depends on the underlying asset. The underlying assets do have monetary and non-monetary benefit. We need to adjust that, and accordingly, we will find the price and the value. The value at initiation is always 0, correct? And overall, the value will keep on changing for either of the position during the maturity of the contract. Just one small thing that I have to mention here is this is not with regards to level 1. Okay. In level 1, you will just be valuing equities, future prices, equities, or rarely like commodities. You don't have to do the valuation for indexes more. So therefore, I have considered how many days in a year for all these equity prices. If you recollect the time value of money discussion, every time I've used how many days in a year? 365.
365.
Correct. So you should use 365 days in a year, and everything we've done compounding raised to t. We've not used simple interest rate, or we haven't even used exponential. We have used only compounding. Clear?
Yes.
Now this is by default, but I've just mentioned it that this is what we do. In reality, now when you will go in level 2, you will understand you will also doing valuation not only for stocks but for index. And for indexes, we do exponential. We don't do 1 plus r raised to 2. We do e raised to rt. That you don't have to worry in level 1. I've just mentioned it for your reference. You have to just focus that the number of days you should take 365, and the compounding, the risk-free rate calculation, you should always compound 1 plus r raised to t, not multiply with t by 365. Okay, raised to. It has to be compounding. Clear?
Yes.
Now that is by default, but we just, I thought that it's necessary to mention it. Is it clear, everyone?
Yes.
Right. Well, that's the end of this topic. Officially, the first two topics, the first topic of derivative instrument basic, and the second topic is about pricing and valuation. Of that, whatever with regards to option, I've pulled out and I've kept in the separate topic, which we will cover on later. Clear? So everything about forward, futures, and swap with respect to derivatives for level 1 is done. Any doubts till now? Let me know with these two topics. If not, we'll cover that in the next section. Okay. Yes. Any doubts? Anything? Anyone?
Nothing so far.
No problem. Just, whatever examples I've given and whatever theory I've given, do not skip anything in that. I've gone on a micro level of going out with each and every line. I would want you all to, now you may not require so much of an effort while reading because you've understood the concept, but please don't skip it. In CFA level 1, don't skip anything. And now it won't take enough time. So I've covered each and every theoretical aspect here and the practical aspect. Even if there are no enough questions in your books for practical questions, I've put those there in form of examples that I know. Actually, I've taken this example, which I do it in level 2. So that's the example that I took here for forward valuation. Okay. So this is really going to be helpful for you in the future also. But this was essential for me to cover how exactly the valuation is done. Right. And the theory that we discussed is very important. So now when you do this both topics, everything about forward, futures, and swap will be done. But in my way, you won't find that exact way in your book because I've taught it product wise. And in the first part, I discussed only the markets. In the second part, I discussed the pricing and valuation. Right. And I've created, as I said, the separate topic where we are going to discuss everything about options. So the pricing and options and the basics of option is what we discuss in a separate topic, which is what I've created for, so that we can, differentiate between the other assets and options, because option fundamentals are completely different. Clear? That's it from my end today. If you have anything, please let me know, or else we'll meet in the next section. Clear? Yes. Anything?
Okay.
Anyone?
Nothing so far.
Okay. See you in the next section. Bye-bye.
Okay.
Okay.
Thank you.
Yeah. Bye-bye.